Hello there. In this session, we are diving into the world of accounting for liabilities. Liabilities are a crucial aspect of financial reporting, representing obligations a company owes to external parties. Throughout this session, we'll explore the various types of liabilities, their accounting treatment, and their impact on financial statements. Let's preview the key areas we'll be covering today in our exploration of accounting for liabilities. We'll begin by discussing salary expenses, focusing on accrued wages and how they become a liability until they are paid. Next, we'll address how the portion of long-term debt due within a year shifts into a current liability and the accounting implications of doing that. We'll also learn how to calculate interest expenses here. Next, we'll examine contingent liabilities, those that are potential obligations dependent on future events, and how accounting standards dictate their treatment. Finally, we'll also touch on lease liabilities, distinguishing between operating leases and capital leases, and also we'll discuss their accounting treatment. Here, we'll introduce the concept of present value and discuss its vital role in determining the true value of liabilities over time. Before we delve into the specific types of liabilities, let's clarify a fundamental distinction within how companies acquire capital: debt financing versus equity financing. With debt financing, you retain full ownership of your business. You're essentially borrowing money that must be repaid. Equity financing means you sell a portion of your business ownership. Investors become shareholders. Debt has strict repayment schedules with principal amounts and interest. This creates a predictable financial obligation. There's no repayment obligation in the traditional sense for equity, but investors hope for business growth and profits, leading to increased share value or dividends. Debt lenders usually have limited say in how you run your business outside of certain loan terms, whereas equity investors gain voting rights based on their ownership stake, potentially influencing business decisions. Interest represents the cost of debt, a fixed expense. If you can't pay, there is the risk of default and potential seizure of assets. The cost of equity is tied to company performance. The greater the profit or share value increase, the higher the cost to the original business owner. Interest payment on debt is usually tax deductible, while dividends paid to shareholders are not tax deductible. Understanding these differences helps businesses choose the right financing. Debt is often used by established businesses with stable cash flow, while equity might be favored by high-growth startups. At their core, liabilities represent obligations a company has to outside parties. These obligations can be financial, such as debts or unpaid bills, or involve promises to deliver goods or services in the future. A critical factor in accounting for liabilities is the time frame in which these obligations must be met. This leads us to the distinction between current and non-current liabilities. Current liabilities are those due within the company's operating cycle, typically within a year. Think of them as short-term financial obligations. Examples include accounts payable, such as money owed to suppliers, accrued expenses like unpaid utility bills, for example, and the short-term portion of any long-term debt. We've already discussed accrued expenses in detail in the third session, if you remember that. Non-current liabilities, on the other hand, are due beyond the typical operating cycle, usually extending over a year. They are our long-term obligations. These may include long-term loans, bonds payable, pension liabilities, and deferred income taxes, for example. Next, let's discuss salary expenses. These are a significant component of liabilities for most businesses. When we think of salaries, we often focus on the net salary, or it's also known as the take-home pay an employee receives. However, from an accounting perspective, there's much more to the story. Let's examine the graphic on the slide. It breaks down the different components contributing to the actual salary expense a company incurs. Gross salary is the total agreed upon amount before any deductions. It includes the employee's net salary and their mandated contributions such as income tax or social security. Note that these employee contributions, which are part of the gross salary, are withheld by the employer and paid directly to the relevant authorities. But companies often bear their own payroll costs on top of gross salary. This employer contribution includes things like matching social security payments, pension contributions, or healthcare benefits, for example. Similar to employee contributions, the employer portion is temporarily held and then paid out to the respective agencies or benefit providers. The key takeaway is that a company's true liability is the salary expense, is the sum of the gross salary plus the employer contributions. But once the net salary has been paid to the employee, whatever is owed to the relevant authorities is the amount that is recorded as liabilities on their financial statements. So the employer contribution and the employee contribution together would be still recorded as a liability in the financial statement. Let's break down some of the most typical components we find within employee contributions and employer contributions related to salaries. Employee deductions and contributions include, for example, income tax. Almost everywhere, income tax is withheld directly from an employee's paycheck as a prepayment of their annual tax obligation. Next, medical or health insurance. If the company provides health insurance, employees usually share part of the premium cost through payroll deductions. Next is pension fund. In pension plans where employees contribute, a portion of their salary is regularly set aside for retirement. And finally, social security. Social security systems vary by country, but this deduction typically funds government programs like retirement benefits or disability insurance. Moving on to employer contributions, first we look at pension fund. Many employers offer matching contributions to pension plans, incentivizing saving and providing additional retirement benefits. And finally, unemployment insurance. Employers typically pay into unemployment insurance funds, which provide support to workers who lose their jobs. Remember that specific types and amounts of contributions will depend on location, government regulations, and company benefit packages. This list isn't exhaustive by any means, and there might be other types of deductions or contributions in certain specific circumstances. Now let's see how the concepts we've discussed translate into actual accounting journal entries through a real-world example. Joe earns a gross salary of $10,000 for the month of January to be paid on the 31st of January. Joe and his employer each contribute an amount equal to 6% of Joe's gross salary to Social Security. Joe contributes $200 from his gross salary to his pension program, and the employer contributes an additional $400. Joe's employer also withholds $2,000 for income taxes. Show the journal entries made by Joe's employer on the 31st of January. Joe and his employer each contribute 6% of Joe's gross salary to Social Security. 6% of $10,000 is $600. So Joe contributes $600 and Joe's employer also contributes $600. Further, Joe contributes $200 from his gross salary to his pension program, and the employer contributes an additional $400. The employer also withholds $2,000 for income taxes. This $2,000 is being withheld from Joe's gross salary. So Joe's net salary or his take-home pay is calculated by deducting his contributions and taxes. So Joe's net salary after deductions is $10,000 minus $600 minus $200 minus $2,000. That's $7,200. Critically, the employer's salary expense extends beyond Joe's gross salary. We must factor in all employer contributions as well. The total salary expense for the employer is the $10,000, which is the gross salary of Joe, plus $600, which is the contribution from the employer for Social Security, plus $400, which is the contribution from the employer for pension plan. Okay, so the total salary expense is $11,000. Now let's record these transactions in the journal entries for the employer. First, we debit the salary expense account for $11,000. That's an expense that brings down your stockholders' equity. Then we credit cash account for Joe's net salary of $7,200 to reflect cash that has been paid to Joe. Next, we credit income tax payable account for the withheld income taxes of $2,000. So this will be a liability that will be paid later. Then we credit Social Security payable account for the Social Security contributions of $1,200. This is $600 from Joe and another $600 from the employer. Finally, we credit the pension plan payable account for the pension contributions of $600. Okay, so that's $200 from Joe and $400 from the employer. All these payables are liabilities for the employer as they have to be paid to the concerned authorities or agencies. Only the net salary had been paid already and hence cash has been credited, but the rest are liabilities that are yet to be paid. Moving on, typically companies raise capital through various debt instruments. Let's examine three common types of these debt instruments, namely loans, notes, and bonds. Loans represent the most familiar type of borrowing, a direct agreement with the lender, usually a bank. They are suitable for short-term needs and they often have maturities under 5 years. Further, loans are frequently secured by a collateral to reduce the risk for the lender. Moving on to notes, think of a note as a more formal IOU, outlining the terms of borrowing, and they are less complex than bonds. Notes are suitable for short to intermediate term needs, usually under 10 years. They typically have fixed interest rates and can either be secured or unsecured. Finally, bonds differ from the other two instruments in that a company borrows directly from many investors in the public market. They are designed for long-term financing. Maturities generally exceed 10 years. Bonds involve detailed legal contracts outlining terms, interest, and any security offered. Bonds are issued by larger companies or government entities. We'll discuss bonds in a lot more detail in the next session, where we have the entire session dedicated to just accounting for bonds. We've discussed the differences between loans, notes, and bonds, especially considering whether they're short-term or long-term. Well, how we classify long-term debt on financial statements depends on its repayment schedule. Let's look at the concept of the current portion of long-term debt. The current portion of long-term debt is the principal amount of a loan scheduled for repayment within the next 12 months or the company's operating cycle. Separating the current portion of long-term debt highlights a company's immediate financial obligations, which is critical for assessing its liquidity and solvency. Let's explore this concept with an example. Joe signs a note to borrow $5 million on the 1st of January for a period of 5 years. The note will be repaid as an annuity of $1 million every year. Show the classification of current and long-term liabilities at the end of the year. Okay, now at the end of the first year, Joe makes the first annuity payment of $1 million. And the next $1 million which is due becomes a current liability because now this is due within the next 12 months. Okay, the remaining $3 million on the note remains classified as long-term debt as it's not yet due. With each passing year, another $1 million will shift from the long-term to current liabilities until the entire loan is repaid. Whenever a company takes on debt, there's a cost associated with it beyond just the repayment of the principal. This cost is known as interest expense. Calculating interest expense is relatively straightforward. Let's break down the formula. Principal, shown here, is the amount of the outstanding loan balance on which interest is calculated. Time represents the period for which interest is being calculated, usually expressed in fractions of a year. So for example, 6 months would be 0.5. Rate, the interest rate is stated as an annual percentage, which is then converted into a decimal for calculation purposes. So for example, 12% would be 0.12 when it's being used for calculation. Accurately calculating interest expense ensures that a company's financial statements reflect the true cost of its liabilities. This impacts profitability and also decision making. Let's apply the interest expense formula we just learned to a real-world example. Below is an excerpt from Joe's balance sheet on the 31st of December. The reimbursement of the current portion of the long-term note takes place on the 30th of June. If the interest rate of the note is 4%, how much is the interest expense for the year? The key is to recognize that interest accrues over time. The current portion is due in 6 months or half a year, while the long-term portion has a full year here. So the outstanding current portion is only $80,000, So 80,000 multiplied by half, because it's being accrued for just half a year, okay, multiplying that with the interest rate, which is 4%. That would give you the interest expense for this 80,000. But what about the 250,000? That is a long-term note payable. So 250,000 for the whole year multiplied by 4%, that gives you 10,000. So 80,000 times half times 4% is 1,600, plus the 10,000 gives you 11,600 is the interest expense for the whole year. Now let's follow a borrowing scenario step by step, examining how transactions are recorded through journal entries. Joe borrows $100,000 for 1 year on the 1st of July. The note carries a 4% interest rate. Joe closes his accounts on the 31st of December every year. The principal and interest will be paid upon maturity the following year. Record the necessary journal entries. So let's see. On the 1st of July, Joe receives 100,000 cash, an increase in assets, okay, creating a 100,000 note payable representing the new liability. Hence, we debit the cash account for 100,000 and we credit the note payable account for 100,000. Even though payment isn't due yet, accrual accounting requires us to recognize interest expense as it builds up. So 100,000 times 4% for half a year. So from July 1st to the 31st of December is 6 months, right? So 100,000 multiplied by 4%, which is the interest rate, multiplied by half gives you $2,000 of interest for the half year. Hence, at the end of the year, on December 31, before we close our books for the year, we debit the interest expense account for $2,000 and we credit interest payable by $2,000. This shows that the expense has been incurred but hasn't been paid yet. On the 30th of June in the following year, the note along with the appropriate interest has to be repaid. Hence, a further 6 months has passed by now. Another 6 months of interest, which is $2,000, is recorded as an expense. So you see an interest expense of $2,000 has been debited. We debit interest payable by $2,000 in order to eliminate the liability that had previously been recorded on the 31st of December. And we also debit note payable for the original loan amount, that is $100,000, in order to reflect that the note has been repaid and it is not a liability anymore. Finally, we credit cash representing the $104,000 repayment, which includes the $100,000 note and the $4,000 interest payment for the whole period of 12 months. Okay, not all liabilities are certain. Contingent liabilities are potential obligations depending on future events that may or may not happen. Think of pending lawsuits, product warranties, or environmental cleanup obligations where the outcome is unknown. Accounting principles such as US GAAP and IFRS provide specific guidelines on how companies should handle contingent liabilities. Decision making relies on two things. First, the probability of an economic loss, and second, whether that loss can be reasonably estimated. If a loss is both probable and can be estimated, it's recorded on the balance sheet as an actual liability. If a potential loss exists, even if less likely or if it cannot be easily estimated, it must be disclosed in the notes to the financial statements. Only true remote contingencies may not require specific mention at all. The bottom line is that how a company handles contingent liabilities reveals its potential financial risks, making this a crucial area for stakeholders to really understand. Moving on, lease agreements. Lease agreements provide a way to acquire assets without an upfront purchase. However, the accounting treatment of leases can be very complex. Let's focus on capital leases under US GAAP. The key concept is that capital leases are in essence treated like a financed purchase. This triggers specific accounting requirements. US GAAP defines 4 specific criteria that must be analyzed to determine if a lease qualifies as a capital lease. We look at each one of them by turn. Ownership transfer. If the lease effectively hands over ownership by the end, it's treated as a purchase. Next, bargain purchase option. If the buyout option is far below the market value, it suggests an intent to purchase. Next, looking at the lease term, a lease spanning most of the asset's usable life signals that it's closer to owning the asset. And finally, present value of lease payments. If the discounted value of lease payments closely aligns with the asset's worth, it's economically similar to a purchase. We'll look at the concept of present value later in this session. If a lease meets any one of these four criteria, it's classified as a capital lease. This means both an asset and a liability are recorded on the company's balance sheet. The decision of whether a lease is operating or capital has a profound impact on a company's financial statements. Hence, before we examine the journal entries, let's clarify the fundamental difference that dictates whether a lease is classified as operating or capital. Think of operating leases like an extended rental agreement. The company does not obtain substantial ownership rights over the asset. As such, operating leases don't appear on the balance sheet as assets or liabilities, impacting only the income statement through lease expenses. Hence, you would debit your corresponding expense account and you would credit your cash account for paying for that expense. Capital leases, in contrast, function like a financed purchase. We saw that in the previous slide. Okay? The company gains most of the benefits and risks of ownership. This is why capital leases require recording both an asset and a liability on the balance sheet. Now, a key issue is, how do we determine the value to put on that leased asset? That's our next important step. Determining the value will involve a concept called present value, which we'll explore now in depth. Present value is a fundamental concept in finance that allows us to assess the value of future cash flows in today's terms. The idea behind present value is based on the principle that money available today is worth more than the same amount of money in the future. Why is that? This can be for a variety of reasons. First, for example, inflation. Over time, prices generally rise, so the same amount buys less in the future. Or it can be due to opportunity cost. If you have the money today, you can invest it to earn a return. Waiting for a future payment means you miss out on all those potential earnings. Or finally, it could also be due to risk. There's a degree of risk in waiting for future cash flows. Things might change and the payment might be delayed or reduced. In the context of the example on the slide, where there is a future cash flow of $100 in year 4, calculating the present value involves discounting this future cash flow back to its equivalent value in today's dollars. This is necessary because receiving $100 in year 4 is not as valuable as having $100 today. Present value is essentially working the investment process backwards. What amount would I need to invest today at a certain interest rate to receive $100 in year 4? The formula shown here allows us to precisely calculate this amount, taking into account both the discount rate and the time period. The discount rate represents the rate of return that could be earned on an alternative investment of similar risk. It reflects the time value of money and accounts for factors such as inflation and opportunity cost of capital. By discounting future cash flows back to their present value, we can make better informed decisions about investment opportunities, financing choices, and project valuations. In the context of capital leases, which we've just seen in the previous slides, we'll use present value to determine what the stream of lease payments is equivalent to in today's dollars. Let's further examine the concept of present value with a real-world example. On the 1st of January, Joe bought a new equipment and signed a note agreeing to pay $30,000 in 2 years, that is, on the 31st of December in year 2. This amount equals the cash equivalent price today plus interest for 2 years. The market interest rate for this note is 12%. Show the appropriate journal entries for this liability. That $30,000 isn't the true cost today. This amount represents the cash equivalent price today plus interest for 2 years. To accurately record this on his financial statements, we need to calculate the present value. Using our present value formula, we discount the $30,000 by an interest rate of 12% over 2 years. This results in a present value of $23,915.82. This means if Joe invested $23,915.82 today at 12% interest, he'd have exactly $30,000 in 2 years to pay off the note. Using this present value, let's calculate the interest expense for the 2 years because we'll be using this in our journal entries. So interest expense for year 1 is the present value, which is $23,915.82 multiplied by 12%. So that would give you the interest expense for the first year. But when we have to calculate the interest expense for year 2, we have to add the interest expense from year 1 to our present value before we take 12% of the total. Why do we do that? Because that's how compounding works, right? Okay. And hence, interest expense for year 2 is higher than the interest expense for year 1. Okay, let's look at how to do the journal entries now. On January 1, in the first year, okay, we debit the plant property equipment account for $23,915.82, the present value. And then we credit the note payable account for the same amount, reflecting the obligation. And on the 31st of December for year 1, because interest accrues over time, we debit interest expense for $2,869.90, okay, as we calculated in the previous slide. And we also increase the note payable liability by the same amount, okay. So now at the end of year 1, the total note payable liability would be the sum of $23,915 and the $2,869. And finally, as of the 31st December on year 2, because another year has passed, okay, we've accrued another year of interest. In this case, the interest expense is $3,214, which we've also calculated here in the previous slide. But Joe pays $30,000. Hence, we debit the note payable account by $26,785.72, okay, which is the sum of these two numbers, in order to eliminate it or reverse these journal entries. And we also credit cash because we paid cash for $30,000. Previously, we looked at finding the present value of a single future payment. But what if we have a series of equal payments over time? That's an annuity, right? Understanding the present value of an annuity is crucial for evaluating things like lease agreements, loan payments, or retirement income streams. Let's explore how to calculate the present value of such an annuity. Our graphic here depicts an annuity of $100 received at the end of each year for 3 years. We can't simply add $100 3 times. We must account for the time value of money using the present value concepts we've just learned. We could calculate the present value of each payment separately using the formula we just learned and add them all together. However, that's very time consuming. Imagine the annuity is for a longer time period. Thankfully, there is a formula that simplifies this process. This formula calculates the combined present value of all the payments in an annuity. Even that can be considered a bit cumbersome because you'll have to remember a formula, right? Okay, so we'll take it a step further. Spreadsheets like Microsoft Excel or Google Sheets have a built-in present value function. The syntax of the function is shown here in this slide. The present value function takes the following arguments. The first argument is the interest rate or the discount rate. The next one is the number of time periods. And next, payment amount represents the constant payment in the annuity. And next, future value is an optional argument. Okay, this represents a lump sum transaction at the end. This can be a cash inflow or a cash outflow. But if there is no such transaction at the end, you can simply ignore this argument because this is optional. And finally, there's one more optional argument, end or beginning, which represents whether the annuity payment is made at the beginning or end of each time period. By default, if you don't provide this argument, payments are assumed to be made at the end of each time period. Remember that lease payments often form an annuity. So this is exactly the tool we need to determine the lease asset value and liability. The present value of an annuity concept extends far beyond leases, making it a very valuable financial tool. Let's explore an example of calculating the present value of an annuity and the corresponding journal entries. On the 1st of January, Joe bought a new equipment and signed a note agreeing to pay $10,000 in annual installments for 3 years. Each installment includes the principal plus interest of 12% on unpaid balance. Show the appropriate journal entries for this liability. Joe purchases equipment and agrees to annual installment payments. These payments include both principal repayment and interest. To record this equipment and liability accurately, we can't simply focus on the $10,000 annual payments. We need their present value. The PV function in the spreadsheets makes calculating the present value of this annuity quick and easy. But let's discuss how all the calculations are made without using the spreadsheet formula. Let's walk through this table. The annuity of $10,000 is the amount that is being paid at the end of each year. So in order to calculate the present value, we'll have to discount each of those annuity payments back to today. Okay, so for example, the first $10,000 which is paid at the end of year 1, in order to calculate the present value of that $10,000, we take the $10,000, we divide it by 1 plus 12%, which is the interest rate, to the power of 1, which signifies that we'll have to discount it back by one time period. We repeat for the $10,000 at the end of year 2. Now we'll divide $10,000 by 1 plus 12% to the power of 2. Now we'll have to discount it backwards for 2 time periods, hence the power of 2. Okay, and we do the same for the third annuity payment. Once we've calculated the present value of each of these $10,000, we can simply add them together to find the present value of the whole annuity. Okay, so that's $24,018.31. From past experience, we know that we also need to calculate the interest expense because we'll be using that in the journal entries. Okay, so how do we calculate that? Interest expense for year 1 is the present value, which is $24,018.31 times 12%. That's straightforward. But what happens at the end of year 1 is that we make a $10,000 payment. Okay, so this $10,000 covers a bit of the principal and also covers a bit of the interest expense which we've accrued so far. So the interest for year 1 is deducted from the $10,000 in order to calculate what portion of the principal has been repaid. And then in order to calculate the interest expense for year 2, we deduct the principal which has already been repaid from the present value. So now the outstanding debt is $24,018 minus $7,117. Okay, so we only paid 12% interest on this outstanding amount. Okay, and hence the new interest expense is a bit reduced. Okay, and we repeat the same process. We see that the principal that has been repaid at the end of year 2 is $10,000 minus the interest expense accrued for year 2. Okay, and for year 3 we repeat the same process. Okay, now the outstanding debt is even further reduced, right? So 24,018, which is the PV, minus 15,089, which is the sum of the principal that has been repaid in year 1 and 2. Okay, so the interest expense for year 3 is only $1,071. The principal that is being repaid at year 3 is $10,000 minus the interest expense. That gives you $8,928. Okay, if you add these three numbers, you can see that the total principal repaid amounts to exactly the present value. Notice how the present value of each payment decreases over time, reflecting the time value of money. Focus on how the portion of each payment representing the interest expense decreases while the principal repayment increases over the loan term. The calculated total present value, $24,018.31, is the amount we'll use for our initial journal entries. On the 1st of January for year 1, we debit PPE for $24,018.31 and credit note payable for the same amount, representing the present value of the liability. Okay, so $24,018 is the present value of the annuity of $10,000, which is at the end of year 1, year 2, and year 3. And for each of the subsequent year ends, we record interest expense based on the outstanding balance and reduce the note payable by the principal that has been repaid. Hence, we debit both interest expense and note payable accounts and credit cash by $10,000 to reflect the cash payment for each year. So for example, at the end of year 1, note payable has to be debited by $7,117, which reflects the fact that the outstanding debt is no longer $24,018, but that has to be reduced by the $7,117 we calculated in the previous slide. Okay, and the interest expense will be debited by 2,882, which we also shown here in the previous slide. Okay, and cash payment of $10,000 at the end of year 1, year 2 and year 3 is also recorded by crediting the cash account. And the same process is repeated for the end of year 2 and year 3. You'll simply have to look at the previous slide to obtain the numbers for the note payable and interest expense accounts that have to be debited. Okay, we're almost done. We've covered a great deal of ground in understanding liabilities, from their definitions and classifications to concepts like contingent liabilities, leases, and present value calculations. Remember, accurately accounting for liabilities is crucial for presenting a true picture of a company's financial health and decision making. The concepts we learned in this session, especially around present value and annuities, will be directly applicable to our exploration of bonds, which we will discuss in a lot more detail in the next session. Thank you for watching. See you in the next one.